Daniel, credit markets often, and this is what you shared with us in the past, and I thought it was really interesting. Would like to hear your thoughts on this. Credit markets often send signals before equities do. Like, what are the signs you look for when a cycle may be turning, and what can we do to respond to that appropriately?
Sure. Yeah. Look, I think there's a lot of things in credit markets that send early signals. Default rates obviously are a big one, where equities might not pick up on some of the credit deterioration in portfolios. Covenant breaches in and not outright defaults, but covenant breaches or loan extensions or things like that. Documentation specific needs for new money in portfolios. To keep businesses going, to enhance the capital structure. Sometimes those are real warning signs. I think when you get into the financial analysis, obviously there's obvious things, delays in inventory turnover and things like that, receivables aging and things like that people get into. Those are very, very specific and usually idiosyncratic, rather than macro type indicators. Look, I think there's been a lot of talk the last couple months about defaults in private credit, for example. I think it's way overblown personally. I think those portfolios. I mean, they are doing sub-investment grade business, right? You're going to have defaults. You're going to have extensions. You're going to have restructuring in those portfolios. That's normal course of business. I think one thing that people forget about is sometimes it's actually better for investors in those types of funds if there is some stress. It's the way for a manager to get some extra fees from these companies, maybe to increase the interest rate, maybe to get some sort of accelerated pay down on certain of the tranches in a deal. So it's definitely not 100% negative to me.